Today we're discussing Hanesbrands Incorporated, ticker HBI. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. This company is in the textiles, apparel, and luxury goods business. They have a market cap of $1.7 billion and enterprise value of $5.1 billion. This is quite significant because it means about 2/3 of the enterprise value is debt. It's about $3.4 billion in net debt, and the market cap is $1.7 billion. This would be the mark of what I would consider just right off the bat, potentially a distressed company that can offer some opportunity if they have really good future returns, but if they don't, then it could portend potential bankruptcy or something along those lines. So let's see which one it is through the rest of this video. Hanesbrands is a consumer goods company that designs, manufactures, sources, and sells a range of basic apparel for men, women, and children. So basic apparel is the key here. They have 3 segments: innerwear, activewear, and international. So they have like underwear, panties, underwear and socks, activewear, intimates such as bras, shapewears, home goods, t-shirts, fleece, etc. So good as well there. They licensed their Champion name for footwear and sports. They also have products under the Hanes, Champion, Maidenform, JMS, Just My Size, Bali, Polo, Ralph Lauren, Playtex, Alternative Gear for Sports, Comfort Wash, Bond, Sheridan, Bras and Things, Wonder Bra, Zubra, Soul, Maidenform, Brand Bros, and Bella brand name. So this is key because anytime you're in a branded business, they have the opportunity, but no guarantee, that they're able to sell goods at relatively higher prices compared to their input costs than other companies because they're able to brand their products. One sign that might not be the case here is they're selling basic apparel. So they're not selling up-end luxury type items, although this does say they're in the luxury goods type industry. The key one here to me is textiles and apparels. This tends to be a relatively competitive business, so that is something to be aware of as well. Now, return on invested capital chart. What this can quickly tell us on a first look is that this business used to be better 20 years ago than it was today because they were earning 21% return on invested capital, and recently they have been losing money. So they earned 17 straight years of profits from 2003 to 2019, but then starting in 2020 they lost money. They lost money again in 2022 after barely making money in 2021. They had a tough year in 2017, but otherwise you had quite a few number of years of double-digit returns. That's actually quite impressive because you see 6 years here, 6 out of 7 years where they're earning 11 or 12% returns on invested capital, which is a very good number, and it looked like they were stable year to year. But you have these big down years. I wonder if these are kind of one-time write-off type things, but that's certainly not true over the last 3 years, as you see 3 years in a row of pretty poor results, which is quite sad when you look at these 10-year median returns here, because what this would tell me is that this is a high-quality business based upon an 11% return on invested capital and a 31% return on equity. These are great historic returns when you average the last 10 years, and that includes 3 terrible years over the last 3 years. One thought is that they have done quite poorly since COVID, but it's not just COVID because they also had a bad year in 2017, but they seem to be struggling in the current post-COVID dynamic, something to be aware of. Otherwise, this looks like an average business. Besides that, you have some up and down years, some years where you have low returns, some years where you have high returns. So even though you're averaging out to a relatively high number here, maybe they were a high quality business in the past, but it doesn't appear so today. Now, the valuation ratio here is kind of useless when it has a negative number. So we're going to have to kind of think about normalized earnings as we go further through this video, because you're just using trailing earnings and you say a company's unprofitable. Unprofitable companies aren't worth much, but they might be profitable on a normalized basis. We'll have to take that into account. Growing revenue at 3% a year, and of course, EPS and free cash flow don't really show as a CAGR if you are losing money. One key that it could be undervalued, though, is the price to sale of 0.3 is quite low for many companies, especially when your current free cash flow margins are 8% as the 10-year median. So it could be undervalued with these sorts of numbers, especially when you think about their current sales of $6.2 billion is above the enterprise value, and that's not a common situation that you would see. Even in competitive industries, you might have pretty good numbers. Now, we need to analyze what's going on here. A lot of the years you had really good revenue growth, but it looks over the last few years you've actually had some revenue declines. Revenue peaked at $6.8 billion in 2018. They matched it in 2021, but of course they're down to $6.2 billion, 10% off the peak in 2022. Anytime you have a company that has declining earnings, that's always a tough thing for a company to deal with, especially very competitive industries. So that's something that is a sign there that is concerned. Now their gross profit is up, almost 50% over the course of the last decade. So that's pretty good. 1.6 billion to 2.2 billion doesn't explain what we're seeing here, especially because the gross margins are still holding pretty strong, 34.8 to 35.6. So it's not really like you're at a cyclical low on gross margins that's really hurting you. Something else is going on. Operating profit is flat, 500 million to 520 million. One thing I do note is this: despite these losses, you do have operating profit in every single year. So it looks like you're having some non-operating items that is leading you into losses. My guess is it would be this big debt that we see. Earnings per share. So we see 81 cents, 99, $1, $1.40, 20 cents, $1.40, $1.64. It looks like $1.64 is the peak. You had 22 cents in 2021, and you had some losses the last 2 years. So you peaked at 2019 at $1.64. So on an earnings peak basis, the company's trading at like 3 or 4 times earnings. Let's just call it 4 to be a little bit conservative. Say 4 times earnings from their 2019 earnings numbers. So what a potential investor would have to think about is, are those earnings something that they can return to? Can they return to making $1.64 per share? If they can do so, and they can do so quickly, this company is probably very, very cheap, because $1.64 per share on a $5 stock price means you're getting 3 or 4 times your earnings per share number, which is very good. Even if it takes a few years to get back to that, that would still be a very cheap price if you could get it, and you could be assured the company's not going to go bankrupt, especially when you look at this dividend yield. So they were paying dividends here of 60 cents per share. Now they might have canceled it since this was made, so you have to take that into account. Maybe these dividends aren't current, but if they're paying a 60 cent dividend on $5 stock price, that's like a 12% dividend yield on your current stock price. Now again, they may have canceled the dividend since when this data is showing and when this video is being produced, so something to be aware of. You would obviously want to check before buying the stock, but that sort of dividend becomes very attractive if the company can go back to earning what they were doing. We have to think, they were paying a 60 cent dividend here, yet they weren't earning that amount for the last 3 years. In fact, 4 of the last 6 years, they've not earned enough to pay their dividend, which is a major red flag. So something to be aware of. Obviously, the market knows that's a concern. That's why this is being bid down to this price. And that's not necessarily a common outcome. One of the things I think it's interesting is this company got on my list of when I would do this video, probably back in 2019, 2020 is when I made the list for this being an S&P 500 company, and the company has cratered since then. And so it's really interesting looking at these current numbers. Now, if you're enjoying this video so far, hit that like button. Don't forget to subscribe. Let's go further into the income statement to learn a little bit more. So one of the things we noted is that they had operating profits in all these years, but then they did lose money on these 3 years. So how did that happen? It looks like some of this is income tax. So they're paying a pretty big income tax number. Some of it is net interest income. This is the key number here, right? So you're positive on operating profit, but you went negative in 2020 because of your big net interest income. So you're paying a lot of interest in order to cover your debt, as I predicted, and that drove you into the loss. And that's what you see there. You also see this with your income tax here is forcing you into the loss on that net income line. So although that's not a common situation where you're going to pay income tax exceeding your pre-tax income, but there could be all sorts of one-time items that lead to that outcome. Now you had 407 million net shares outstanding. You end at 350 million shares outstanding. So you've retired a little over 10%, 10, 12, 15% of your shares outstanding in a decade. That's going to add about 1% per year to the EPS growth that you would have. The problem is you've gone from earning money to losing money, and so it's not going to save you to buy back shares if you're losing money. I would expect, if they haven't already, that they would be stopping their buybacks based upon what I'm seeing here. Now, your big capital expenses here looks to be basically working capital and PP&E. PP&E is $857 million. Inventories of $2 billion. So you have about $3 billion in like true assets here. Plus you get this, so $3 to $4 billion in assets between the total current assets and the PP&E. I don't really like to count cash there, but you have a lot of goodwill and intangibles, which I wouldn't really make a big deal about. So that kind of plays into what you have there, but you're still not earning money, so it doesn't matter. But it does mean on the previous 2018, 2019 earnings, you have some really good returns on your tangible capital, 20% type returns on your tangible capital when you're actually making money. But the problem is they're not making money anymore, and so that becomes very difficult. One thing we see is, of course, their debt has almost tripled in the course of a decade, 1.3 billion to 3.6 billion. That's always a concern because you couldn't really repeat that again based upon how this business is developing. Your debt already exceeds your total current assets, and your debt exceeds, your PP&E plus inventory and account receivable. You're in that range. It's kind of risky. This would definitely be a red flag. This company's being played on a very leveraged basis. I mean, you compare the debt of 3.6 billion to shareholders' equity of 400 million, and so you have over 10 times as much debt, or 10 times as much debt as you do shareholders' equity. That's like the leverage of like a bank. So there's a lot of risk here in this business from what I'm seeing. This balance sheet on its own, if it wasn't for the income statement, would still kind of discourage me from investing in the business. It's very leveraged. It's very risky. And of course, that's what you're going to be betting on if you were to buy this stock, is a very risky setup. You're trying to hope for kind of like them getting out of this situation, and any sort of recovery would see the stock price go up a lot. But I mean, these numbers are horrible. Not good at all. You do have some stock-based compensation, which is kind of poor because you're going to start diluting the company because they don't have money anymore to buy back stock. They never really bought back stock consistently anyway. You can see that they're paying dividends here, but again, 210 million in dividends every year is not good when your net income is so low. They do have some of that money in cash flow from operations, but you really need that cash flow to pay down debt. Instead, they're really taking on more debt, and so that's a major concern. Although over the last 4 years, they kind of like even out in terms of their debt. Overall, this business is just struggling. Hanesbrands used to be a company that I believe was a type of compounder. You can see that when you get these really high, nice double-digit returns on invested capital. You do that over a long period of time, you can really compound your earnings at a good rate. But they've really struggled. It looks like they've leveraged up too much, and when they had a decline in revenue, this business has really run into some problems. One thing I want to look back on the income statement, you see about $1 billion in SG&A to $1.8 billion in SG&A. So their SG&A has grown 60 to 70% over the course of a decade, despite the fact that their business has not been able to continue growing. That's a major concern because they've not been able to translate that down to the bottom line. They're starting to get probably some reverse operating leverage, and you don't like to see that. That is why you have this operating margin of 11% down to 8% in 2022. Overall, Hanesbrands is going to be a pass, which is a little disappointing because I always knew this was a company that had compounded really well in the past. If it gets back to that, shareholders could have a really good future returns, but I see a lot of risks here. There's risk on the income statement when you're losing money. There's risk on the balance sheet when you have such a weak leveraged balance sheet. And then, of course, there's risk in the cash flow that they're continuing to pay dividends that exceed their current earnings capacity. So thank you for listening, and until next time, stop paying fees, start building wealth. Hit that like button. Don't forget to subscribe. Thank you for listening.